Or the 14th of September 2007. People queued outside Northern Rock branches across the country to withdraw their money. Televisions showed the images, hundreds of people waiting in the rain outside a high street bank. It was the first bank run in Britain for 150 years. Within 5 months, Northern Rock was nationalised. The Bank of England had extended emergency support. The government had guaranteed all deposits. Northern Rock didn't fail because of fraud. It failed because its entire business model depended on something that stopped working. Northern Rock was originally a building society, a mutual owned by its members, taking deposits and making mortgages. It demutualised in 1997 and listed on the London Stock Exchange. Under CEO Adam Applegarth, it grew fast, very fast. By 2007, Northern Rock had a mortgage book of nearly £90 billion. It had become the 5th largest mortgage lender in the UK. But here's the thing about that mortgage book. It wasn't funded by deposits. Most banks take money from savers and lend it out as mortgages. Northern Rock had a different model. It borrowed money on the wholesale market from other banks and financial institutions at short-term rates. Then it lent that money out as long-term mortgages. And when those mortgages were on the books, it packaged them into securities and sold them on. This freed up capacity to do more mortgages. Then it borrowed more short-term money to fund the next batch. The model had a name: originate and distribute. This is red flag 7 from our free guide. Link in the description. Off-balance sheet risk. Funding structures that depend on conditions remaining stable. Northern Rock had essentially parked risk in securitization vehicles while remaining dangerously dependent on wholesale credit markets to keep the tap running. And Northern Rock wasn't just any mortgage lender. Their signature product was the Together mortgage. It allowed customers to borrow up to 125% of their property's value. 125%. When house prices were rising, this worked. When they stopped rising, the loans went underwater. By 2007, roughly 75% of Northern Rock's funding came from wholesale markets. The industry average was closer to 50%. This is red flag 5, a business growing its exposure to a specific risk far faster than its peers, without a structural reason that makes the comparison invalid. On August 9, 2007, BNP Paribas froze 3 funds because it could no longer value the structured credit assets inside them. The wholesale credit markets didn't freeze overnight, but they tightened. Then they tightened more. Northern Rock ran out of funding. On the 13th of September 2007, the Bank of England announced emergency support. The following morning, the queues started. Within days, £2 billion had been withdrawn. Northern Rock was nationalised on February 22, 2008. The total government exposure, loans, guarantees and equity peaked at around £55 billion. Adam Applegarth resigned. A funding model dependent on wholesale markets that could disappear in a crisis. Red flag 7. Growth far outpacing industry norms with no structural justification. Red flag 5. Asset quality. 125% loan-to-value mortgages that deteriorated the moment house prices moved. Red flag 3 applied to the asset side. The business model worked until the day the tap turned off. That day came in August 2007. The guide is in the description. Free download. Northern Rock, founded 1965, nationalised 2008. The queues said everything. Anyway,